Well, kia rana, tātou katoa, tēnā koutou katoa, and a happy new year to you all. Very pleased to see you all back. 2020, a new decade, and as always, mā tēnei mā mano ko rapa te whai. Many hands make light work, and I want to thank our very competent and capable economics team, our communications team, and of course my fellow colleagues in the Monetary Policy Committee. We have Brian, Peter, I think Caroline, is she? Bob, Peter, Jeff, Christian, Jung, and myself, and I can't see Caroline, she must have gone home. But anyway, thank you very much for your help and consideration. As you're aware, today the Monetary Policy Committee has decided to keep the official cash rate at 1%. Employment is at, if not slightly above, its maximum sustainable level, while consumer price inflation is close to the 2% midpoint of our target range. Low interest rates remain necessary to keep the employment and inflation around our target. Economic growth is expected to accelerate over the second half of 2020, driven by monetary and fiscal policy stimulus, as well as the high terms of trade. The outlook for government investment is stronger following the government's announcements in December, and there are many indications of household spending growth increasing. However, soft momentum in economic growth has continued into early 2020. The slower global growth over 2019 acted as a headwind for domestic growth. In addition, the competitive pressures in the New Zealand economy and recent subdued business confidence has suppressed business investment. We believe the global economic environment has shown signs of stabilising and trade tensions have reduced somewhat. However, the COVID-19, the coronavirus outbreak is an emerging downside risk. For our decision, we assume the overall economic impact of the coronavirus outbreak in New Zealand will be of short duration. This is our working assumption, and with most of the impacts in the first half of 2020. We recognise and acknowledge that some sectors have already been significantly affected. There is a risk the impact will be larger and more persistent. Monetary policy does have time to adjust if needed as more information becomes available. Just before we go to question time, I do wish to acknowledge our sadness at the passing of Emma Jolliffe. Our condolences and deepest sympathies go to her family and to her friends and colleagues, some of whom are in the room here today. I know that we will miss Emma here at the press events that we have at the bank, a wonderful person and a true professional. So our sympathies to all. With that said, we are open to questions. I think we announce who we are and then fire ahead.
Brian Fallow, you say the bank has time to respond, but how much scope do you have to respond when you're within cooey of some sort of effective lower bound? In the event, I mean, the forecasts seem to assume that this epidemic will remain largely confined to China and will peak within weeks. But what if it metastasizes into a global pandemic that, for example, reaches us?
Our working assumption is taken from the whole of government effort. So as you would be well aware, we are not the health experts, so we take our lead from current information. And so we are looking at around, I would say, a 6-week hiatus disruption. The working assumption is that travel bans are lifted and there's some renormalisation over the month of March with some lingering effects. So that is a working assumption. How much would we need to respond? That's going to be a function of what we're responding to. And without doubt, monetary policy would only be part of any response. There is ongoing response already through traditional automatic stabilisers from government transfer payments, IRD efforts. There's a whole of government type of response that can go on. The monetary policy response would be a bit player in that. You do recall as well that whilst there is the zero number not far from one, still the same distance than when we last talked, but we've continued our work around the unconventional monetary policy areas. But the other part, and I think it's important to remember, is that even if monetary policy doesn't shift, relative prices do. The slope of the yield curve, shape of the yield curve, our exchange rate are all moving in real time to information that matters as far as the Reserve Bank and monetary policy issues are concerned.
Hi, Brent Edwards, NBR.
Right.
In terms of the decision today, had the government not gone ahead with the investment announcement, $12 billion in December, would that likely have altered the decision that you might have come to?
Without a doubt. I mean, what we're seeing here is that monetary policy has friends in the sense that we are confident around the fiscal spending that will happen, that shifts some of the burden off monetary policy alone for us to continue to achieve our inflation and unemployment objectives. We see the fiscal impulse as significant in the country over the period that is important to us for monetary policy. And, the direct spend alone is about 0.6 of GDP per annum over the forecast period. We have to make our own assumptions about how much that then feeds into the economy. But it's a significant part around the confidence we have with our projections.
Mike Wesley-Smith from News Hub. Firstly, thank you very much for your comments before. Emma was a significant presence in the newsroom as she was here, and I will try and live up to her high standards. Speaking to tourism operators in Queenstown, some of them have seen up to a 25% drop-off in what is their busiest period. For those that are, for whom business confidence is really low, what kind of assurances can you give them in terms of how you might be able to assist?
Yeah, first of all, acknowledgement that we are aware of these issues and that, this is our working assumption. We see the main effects going through the trade channels, the financial channels, and then the broader confidence channels. What's sitting in our projections is really just the first two channels. What have we observed to date, and what do we expect to continue over the period, the 6 week plus? And without doubt, tourism, right in the face of it, and it's not just direct Chinese tourists, but it's also other people who are becoming more cautious about travelling. Likewise, some of the agricultural sector, the forestry sector are being impacted directly, the aquaculture sector. So there are pockets of deeply affected parts of the economy. We are looking at the aggregate picture. The answer is do all you can, make sure you're diversified, talk to the wider government agencies as we've heard those government agencies call out to.
Thomas Coughlin, Staff. In previous MPSs, you've called on the government to be more of a fiscal mate to your monetary policy, but in this MPS, you're saying that the overall effect of the stimulus package will be somewhat smaller than some of the forecasts. Have they gone wrong somewhere? Why it appears that you're somewhat underwhelmed?
No, I certainly wouldn't want to appear ungrateful, because that is certainly not the case. The fiscal spend, both from the budget last year and then the additional announcements we saw in December, are a significant part of the overall expenditure we see in the economy and has provided more confidence and spending support for monetary policy. That comment that we talked about more is about there's a headline, these are the dollars we're going to spend, the 12 billion, 8 billion of which over the period we're looking at. Spending, they are going to be doing it. what might it crowd out or crowd in elsewhere in the economy? So we always have to make assumptions around, well, if you were going to build the house, who's not going to build the house, or what resources, etc. So we take the Treasury's assumptions, we think about it through the dynamic economy, and the net impulse is always slightly lower than the direct impulse, if that makes sense. So having said all of that, it is still a significant positive spending impulse for the economy over the period.
That's right, and it does give us more confidence that the growth projection we've got built into sort of over the next 2 years is more likely to take place given the intentions by the government to actually spend that extra $12 billion, which wasn't there this time 3 months ago.
Financial stability balance sheet wise, Christian? Yeah.
Yeah, I think from that perspective, it gives us a bit more confidence in terms of where's the macroeconomic stimulus coming from and whose balance sheet is being used to fund that. In the absence of fiscal stimulus using the sovereign balance sheet, we might have lower interest rates and the household sector having to provide more of that balance sheet to have the stimulus.
Can you just give us a bit more of an insight into how you came to your conclusion on the impact of the coronavirus on the New Zealand economy, just given how large how large a part of China plays in our economy, and also the possible disruption to global supply chains? I mean, tell us how you came to the conclusion that this will be relatively mild and fairly short.
I wouldn't say mild. I mean, we've taken, half of the GDP growth we expected in Q1 off the table, and some of that will remain off the table, the level of output. You can't suddenly re-export the crayfish or make the tourists come back in a season they don't want to be here. So that is a direct impact. Having said that, no one, and particularly a central bank, can project how long or how serious this issue is, and so we've taken clear working assumptions from the experts, the health experts, trade experts, and fed that into our forecasting framework. What does that mean? It means that direct impacts that we can see are captured, so we've shaved the export profile considerably, tourism, education, logs, crayfish, so on and so forth, that we are hearing about. We've allowed that to also linger for some time. But we're on the working assumption that some sense of normality around travel restrictions, etc., returns over the month of March or there or thereabouts, but persists for a while. So there are many working assumptions that we've put into the projection, and we're trying to be as clear as we can be with those assumptions so that people can see what have we included, as well as what else might we have to include if this persists and gets more serious. And what we might have to include becomes second round impacts, trade channel impacts, business confidence and investment impacts, all of the usual suspects that we've outlined in our special chapter. Jung, you've studied this.
Yeah, I mean, we're also mindful that there are sort of non-linear or cliff effects. So in the education sector, for instance, even if the travel ban's lifted, there might be a point of no return in terms of, academic
for this year.
This year. So those are things we're mindful of. But to date, based on the information we've got, and I should make a point, we are part of a broader all-of-government economic watch group. So we are getting the same information from that the MB are providing, Tourism New Zealand and MPI. So we're all working with the same working assumptions, and we'll be able to revise, monitor and reassess as that information gets updated.
The other thing I'd add as well is, in addition to the negative impacts that we're seeing, we're also able to factor in some of the automatic stabilisers that are happening. So the fact that the exchange rate's lower, the fact that the yield curve is lower and flatter, we need to work those assumptions in as well and how they work their way through.
Janae Tibshirani from interests.co.nz. Just have a question about the projections. I understand these were done earlier in February, on February 5. Are you confident that things, particularly with coronavirus, have not changed materially from Feb 5 until today?
Yes, we have. I mean, we've been checking again part of that whole of government. We've been trying to stay on top of it as much as we can. Obviously, we had to lean in and make some of our own assumptions from Feb 5 to see where we are now. And I'd have to say, through good luck or skill to be determined, that's broadly how it's played out with regard to visitor numbers coming in and some of the sectors that are impacted. The assumptions were made still stand. And so that's where we're at with. It's interesting, you've seen global equity markets actually continue to rally. You've seen it's a combination of reactions that we're observing at the moment. So we're sticking to what we can see and listen to the experts.
Bernard Hickey from Newsroom Pro. Governor, what do you think of the idea of an insurance cut in the official cash rate, just in case it gets a lot worse? Because in theory, you could unwind that. Did the committee or the bank consider that?
We considered the benefits of up, down remain the same ad nauseum as we always do as the committee. At this point, we didn't see a need for a cut in the OCR with regard to a specific event at all. We have to remember we already have very low and stimulatory interest rates. We have a very good starting position with inflation at its midpoint, employment at maximum, if not slightly above, global growth having stabilised. So, there are a lot of reasons why we have time to hurry up and wait. And so, the insurance cut is not really obvious how that would actually assist. To date, the impacts have been so sector or industry specific that other arms of assistance and other relative prices would be doing far more work than a lower official cash rate.
Just a couple of follow-ups from before. Firstly, I think you made some comment. The working assumption seems to be based around travel disruption lifting in March. Is that right? And can you tell us what that is based on?
Yeah.
So we're assuming the travel ban to date still stands until the 14-day stand down, so that's mid-Feb. But we've made some working assumptions that essentially arrivals from China don't happen in February and some sort of normality over March. So essentially it's like a 6-week window essentially where we get fewer arrivals from China and we've basically fed that through the numbers. So you end up with a hit on GDP of about 0.3 for that first quarter.
And is that based from information that you've been getting from other government departments?
That's right. So I think Treasury released, I saw a headline about the economic assessment and it's basically in the same ballpark. It's the same numbers that Treasury are using.
And we're all very prepared to accept that these are working assumptions, and the best we can do is at least operate off the same page and make it transparent as to what those assumptions are, for two reasons. One, that we remember what the assumptions were so we don't double down, and the other part is to allow people to see that and be able to build information around as information arrives.
Governor, the financial markets are expecting inflation over the next 10 years at around 1% or sometimes even lower if you look at the 10-year forwards measure. Are you concerned that inflation expectations in the long run are starting to get so low that you might have to really rev the engines to blow the cobwebs out of the system?
We always have to be cognizant of long-term inflation expectations. As you're aware, we do our own surveys. We've been pleased to see that the 2-year and 5-year ahead inflation expectations for Aotearoa New Zealand remains almost smack on 2%. I don't know if that's laziness in respondents or credibility in the bank. We will accept the latter. So inflation expectations remain well anchored at the midpoint. When you say hard on the accelerator, we are. A 1% nominal interest rate is a very stimulatory monetary policy situation. I'm almost, we've kind of, I'll ask myself a question. If you're at midpoint of your target on inflation and employment, why aren't you raising rates and renormalising? So, it is about always looking forward, knowing that we are working into these headwinds still.
Yeah, with regards to the inflation expectations from markets, we do monitor those closely. We are aware that there are some illiquidity discounts and inflation risk premium in those numbers, so you need to interpret them carefully. We read less into their levels and more into their direction. So back in August, we had both market measures and survey measures falling, and that was a strong signal to us. At the moment, we have survey measures lifting towards target, and we take comfort from that.
Rebecca Howard from Business Desk. I can see in the November OCR track there was a slight possibility of a rate cut, and now the track shows that the next move is up and sooner than it did in November. So I was just curious as to what it is that gave you the confidence to strip out the possibility of a rate cut. Is it entirely that $12 billion, or are there other factors?
No, and part of it is seeing the economy. You know, what we had was a 0.9. Now we've got a 1.0. You know, you could talk about that as a nuance of rounding errors and projections, or you could put more meaning into it. We're comfortable with that meaning in the sense that we have had strong employment growth continue to come through. We've seen the wage growth come through as anticipated, but it's now here, which means monetary policy is doing its role. We've seen global GDP growth stabilise. It went from 4% growth down to 3%, but it stabilised with early tentative indicators that we are in a more positive global growth position. And then the fiscal overlay as well. So it's a part about seeing what you're hoping come to fruition. That always gives you confidence, as well as being surprised to the upside and getting new information. So that's what we are talking about today. What's happened in between time? We could have skipped into work for the brand new 2020 decade, but of course coronavirus has turned up. So we've got something new to overlay and be concerned about.
But also, just our terms of trade have also surprised on the upside too. So it's not just one thing that's tipped us over.
Yeah, it's fascinating watching New Zealand's terms of trade, how positive they've been and how they've deviated from global commodity prices. So there's some one-off reasons, but there has been a strong underlying trend as well.
Tracy Withers from Bloomberg. I understand what you just said, but you're projecting 3% growth this year. Some economists are 2.2. I mean, what is the difference? What are they missing?
0.8. Sorry, Tracy, being cheeky there.
Yeah.
I don't know. I'd have to find out what is in their projections. I can only tell you what's in ours and the confidence we have around it. Actually, the other side is household wealth has been rising. Asset prices are back on the roll. So we're very pleased that the expected channels of monetary policy seem to be alive and working well. And this is where the growth rates are. I can't talk to other people's projections.
You've got a slower potential growth rate too, I think, that I see that in the brief chance to read the document. I mean, so inflation's just around the corner, yet your projections don't reflect that either.
We've got a picture of inflation basically slowly grinding towards or hanging around the midpoint. That's consistent with an economy that's operating near or at capacity. So part of it is a growth pickup. We think we're slightly below potential and we'll be slightly above potential in about 12 to 18 months' time.
And in numbers terms, type of growth rate terms rather than levels, we're seeing growth going from around 2% now to around 3% by the end of the calendar year. Potential growth rate is around 2.5%. So you can see we're going from under to slightly over. And so it takes time to pick up that capacity and lead to that type of inflation pressure. And that is why we've still got our interest rates at a stimulatory level, especially once you overlay all of the other uncertainties around it.
Hi, John Mayer from Reuters. Given the outlook and what's happened over the past 6 months, would you say that you don't expect to have to move into anything like QE or negative rates, more so than perhaps what the outlook might have been 6 months ago?
Giving us confidence that, one is still as close to zero as it was last time, and our forecast errors, I imagine, will remain around the same size. I think last we talked about on standard forecast errors, there would have been a 20% chance that we could have an interest rate profile below zero, and so that would still stand. which is why also we still have work ongoing in the bank around unconventional monetary policy tools. And that is, again, not core to our projection. It's just about us being sensible central bankers. It's best to be prepared and understand what works. It's not us with any sense of increased probability that they'll ever have to be used. And I know that, Christian, over coming weeks, you'll be...
Yeah, that work goes on, both the policy work and the operational readiness work. We've been very open about it. We're working very closely with the banks about their readiness for being in an unconventional space. We've worked with the MPC members on the principles by which we would use to choose different tools if we were to go into unconventional monetary policy, and we're very close to being able to publish those principles and share those with you shortly.
But we certainly took the view, and that was our least regret view, and Bob and Peter, we spoke a lot about the Monetary Policy Committee some time back, where we thought the risk of doing too much too soon was much less than doing too little too late, and that is why we did the 50 basis point cut and got to this 1% level to put us in a more sustainable position. And we're pleased to see that the economic indicators have followed through. So we'll be prepared, and hopefully we'll never have to use them.
It was only last month that concerns spiked about a Gulf war and presumably an oil shock. Can you illuminate your thinking about geopolitical / Trump risks when you do monetary policy?
Yeah, thanks for asking, Brian, because I think, it's natural humans, we get excited and interested in what is the most recent thing to worry about, and so, the coronavirus. But without doubt, we have said global growth is stabilising. It is tentative. There are early signs and signals. Some of the most strongest signals are asset pricing globally, but other production signals and export business production confidence, etc., on the way through. But let's not forget how broad, how tentative those signs are, and how easy they are always to destabilise. So the geopolitical overlay will always be there. I can't predict what next it is, but we do, whilst we're saying, yay, it's stable, we are still being very cautious and hence comfortable in our very stimulatory monetary policy. The oil price, I think we got a running assumption of US $60 a barrel,
Yep.
and it's been well south of that over the last couple of weeks.
Just back to that stimulus package, have they sated your appetite? Is there any? Are you still making those calls, or do you look at that issue as somewhat closed now?
Around fiscal spending.
Yeah.
Yeah. We don't run fiscal policy, so that's that will be in the government's decisions. What we were saying is monetary policy needs assistance, and they've made long-term infrastructure investment decisions, brought it forward, and that has been good. We're not having any additional ongoing public cries for more. We're very excited about seeing it put in place. A real interesting challenge for us is we're all very keen to talk about the competitive crowding out of resources. I'm very keen to see the crowding in of activity if this infrastructure is in place. What other business investment is then released and able to come through? So at the moment we've erred more on the crowding out, but over the longer time horizon, what it does to our potential output and what it does to business investment motivation will be what we'll watch together. Yeah.
I'm just wondering if you are pleased with the way the 50 basis point cut has gone through the economy. Obviously, we have the government spending and house price growth has really taken off. Are you at all concerned that too much stimulus is going through the house price growth channel?
I'll answer just very narrowly, but then I'll have Young and Christian to talk about the channels of what has made us confident it's working. But we want to make sure the central bank, being both the monetary policy and the financial stability arm, that the right hand knows what the left hand is doing, or vice versa. So, we've made our OCR decision. We then ran it past the experts in the bank who paid to be concerned around the broad stability, and the general consensus was, for now, marginal changes to the interest rates doesn't materially impact the risk levels that sit across the balance sheets in the country. That's not to say that low interest rates now and ongoing forever won't lead to much more significant challenges, which we've talked about. But in the monetary policy cycle and at the current conjunction, we're comfortable with where it's at. That doesn't mean all people who are out of the housing market will be, or whatever. Unfortunately, we set interest rates once and for the country as a whole. Just some of the channels you've seen?
Yeah, sure. I mean, more general point is that we were confident that the policy transmission was still working based on the research we released late last year. And when we look at the data, it's largely playing out that way. So that when we lowered the OCR, we saw the flow through to financial market prices, to retail mortgage rates, much the same way as they have always been. That gave us one degree of confidence that policy was still working. And then, so that had a direct cash flow impact on household incomes. And then secondly, we're seeing more generally the impact on asset valuations, which is another part of the policy transmission. And that seems to be coming through, not just in house prices, but more broadly through asset prices. So, yeah, those two together, it just gives us confidence.
And just tying back to what Christian said earlier, it gives us some sense of confidence that the Crown balance sheet is being used and lent on more so now than just having to rely on the household or the business balance sheet to be the all consumer. And so, it's a better balance across the balance sheets. We know the Crown fiscal position and all of the positive things there. We remain concerned about just household indebtedness and also some pockets of rural indebtedness. That's kind of a long-term structural challenge for us, and why we have been pretty persistent with some of our other levers, such as our loan-to-value ratio, just keeping hold on that.
Governor, at the beginning of the monetary policy statement, there's a comment that the economy might be even slightly above its maximum sustainable level for employment, and that some members of the committee were worried about further upward wage pressure. Could you just talk a bit more about why you think, or the committee thought, that there might be even that the economy was running above the maximum sustainable level, because unemployment's not down at 3.5% where it got in 2007, and apart from the minimum wage increases, there's not a real sign that private sector wages are really taking off.
Yes, I mean, part of that comment, highlights how difficult it is to assess something as maximum sustainable employment. You mentioned 3.5. I mean, that might have been maximum or minimum unemployment or maximum employment. It's not necessarily maximum sustainable employment. So we're talking about the pace at which the economy continued to grow, continue to absorb resources without creating generalised inflation. As you're aware, and in fact the table, I think it's table 2 in the appendix to our document, outlines our array of measures of employment and maximum sustainable employment. When we started this journey of our dual mandate, I would say 2/3 of those indicators sat either at the midpoint or below maximum sustainable employment. That is completely reversed. We've seen them all drift across to being indicators of above or at maximum sustainable employment. So that gives you a sense of why our balance of risk has shifted to at, or if not slightly above. But it also points out how difficult the concept is. So we've got much more work. We're not consigning New Zealand to some particular level of maximum sustainable employment. That's not in the hands of monetary policy. It's us just to be feeling our way through as the dynamics, the structures, the mobility of the labour force grows, changes. At present, that's our best guesstimate. On the wage pressures, yes, we deliberately and wanted to talk about the public sector wages to say, hey, we are awake at the wheel, we are seeing this stuff. We wanted to talk about whether it mattered or fed through into all wages, what's the knock-on effects, and also what's the pass-through into consumer price inflation. And, our general outcome is that it has been well-behaved and relatively benign. So, the wage rises we've seen are part of the monetary policy. We should be pleased to see it. It's not something to panic at, but we need to always keep an eye on that. Patrick?
Thanks. Look, we've had a number of questions that have come through on social media through Twitter. A lot of them have already been addressed here. But one that did come up was your forecast. They're showing a stronger pickup in household consumption. Can you talk us through some of the drivers of growth?
Yes, so on the consumption side, it's one, in fact, where we've got a strong central path and also some members feeling that it might be some more persistent, strong consumption growth than what's in our forecast. What's driving it? Earnings. So people are employed, real wages are rising, and that is being spent. Also, wealth. Again, as we know, the single biggest asset in the New Zealand household is equity in the home, and with house prices rising, people, that wealth effect is still alive and giving, and people will be more confident to consume and/or borrow to consume. So that's the core underlying driver of it, and we have seen consumer confidence well above investor confidence. When we're at home, we seem happy to spend. When we're in our business, we seem concerned to spend.
Yep, and also, terms of trade by another name is just another form of income for New Zealand. So terms of trade are higher, so that should flow through to higher household incomes and spending as a result.
I've got one more here as well. Look, you forecast house prices to increase further from already expensive levels. So how do you think about the associated financial stability risks within your monetary policy framework?
It's a great question, and pass my love on to my mother. What we've got there is around a 7% peak in annual house price growth. That is well south of the double-digit house price growth that we've seen. And part of that is because you are starting from a high, elevated level of asset prices. So it's very hard to double the price. If it's at 20 cents, you can get to 40, but if you're at $1, can you go to $2? And so it's a lot of just that. The known affordability is stretched. So while we're seeing some momentum, we don't believe it's going to be, our projections suggest it's not going to be as strong or as persistent as what we've seen in past house price asset cycles. In addition, of course, we are building, and residential permits and activity, net immigration has slowed somewhat, so that supply-demand is working its way through. But there is the affordability gap. How do we think about it in terms of financial stability? One is from the institution side, i.e. what are the banks doing and how are they managing their portfolio? And we're very comfortable with that because their portfolios are very diverse. We talk about a housing sector, but it's a very heterogeneous housing group. Having said that, we've got the loan to value ratio overlay on them to make sure that they can't get too carried away. Within specific households, there will be some extreme positions, and that's where we've always said interest rates are low now. They will be for a while, but they won't be forever. Stress test yourself. Think hard about the type of risk that you have taken on board, and can you weather that? The number one factor that generally tips up the financial sector and household sectors is employment. An unanticipated shock to unemployment for a variety of reasons. We've been talking about one possibility today. That's the type of stuff where banks have to be well behaved, but households really struggle. It's not necessarily meeting the interest payment. It's about having a job and an income. And, in our projections, unemployment remains low and stable. I hope we're right. Yep. So, last question. It's going to be a good one too.
Yeah, sorry, it's just a follow-up to the earlier question about, advice for those who might be in the tourism business. And you mentioned to diversify and talk to other government agencies. Can you maybe expand what you mean by those comments?
Yes, I know it's going to sound glib, but the first thing is all tourism operators should have more than one market. Think hard about how you can divert into the domestic market and or other markets. So that's without doubt the continuous and forever challenge of all businesses, diversified, many channels of wealth. I know it's hard to say right now, but it should be the beginning proposition of any business. What is my key risk and how can I diversify? The other part around it is that government and government activities, agencies from transfer payments, welfare payments, provisional tax delays, all of those types of things are alive and operating every day. pick the phone up, talk to the IRD. I know that that's what has been the call. The Prime Minister, I saw in the cabinet briefing, saying over-communicate to these people, whether it's MSD, whether it's IRD, and I know the New Zealand tourism sector are seriously over-communicating to all participants in that market about things to think about and how to manage. I'm old enough to remember how quickly our tourism sector shifts from international to staycations, i.e. We might all stop travelling internationally and that picks up some of the slack domestically. So there's a lot of different ways, but over-communicate and use all those avenues. Wonderful. Thank you very much.